Yep.
Awesome. Cool. Okay, cool. Hey, so I think I always start with this good morning, good afternoon, and good evening with all my events. So I'll start saying that. So good morning, good afternoon, and good evening for all the folks joining us today across the globe. First of all, thank you so much, Mark, for providing this opportunity. I before this deep diving and then give you a perspective about like what India and what the opportunities in India. Let me start giving a brief intro about me. Kiran, as you can see on the screen, I recently moved back to India after spending almost close to a decade in New York. Used to be in Jersey City, right across the Hudson. My background has been did my public policy at Columbia. Spent some time in private equity. Have been running a family office network over the last 2 years. With the focus on educating families to drive investments into India, educating them about the alternative asset classes and the opportunities there in the region. So whenever I speak with investors these days, I always, talk about three regions. Even though I come from India, so you always need to look into India, Southeast Asia, and Africa. So this is where you are going to make humongous amount of money in the next, decade or two. These are the regions that you cannot miss. Uh, I when I interacted with a lot of family offices back when I was there in New York, people had a regret feeling that they missed the China boat back in 1990s. I always tell people now, don't miss the India boat, don't miss the Southeast Asia boat, and above, don't miss the Africa boat as well. So the time is ripe, for disruption in these regions, and there's a lot that is happening in these regions as well. So the way how we are going to do this in our today's, I'll briefly talk about India from a 30,000 foot high. As Mark mentioned, we seek open dialogue. So feel free to chime in. Feel free to share your experiences. I know this is not a presentation. This is more of a conversation that we would like to have here. So after my presentation, we will have two panel discussions. We are joined today by experts from India and abroad who had deep investing experience and who understand the space. We will intro you to them, and we will hear their work in India. And again, we'll keep the dialogue open. So please keep your questions coming in the chat box. We will take them as they come along. So talking about India, I think what this Mark, just give me a heads up about the time. I sometimes I just get carried away, when I talk about
By the
India.
way, when I do this, I
Sure.
throw yellow background.
Perfect. Awesome. So just to get started about India, I just want what I would like to do today is just build a thesis about like how India as a country back from 1947 to as of today in 2021, right? So if you see India is a very young country, 75 years old, and there's so much to be done in the country. So I'd like to divide the phase of growth in India into, I would say, into three different phases from 1947 to 1990, 1992, so say close to 2010, and then the last decade, and then 2021 to the way forward. So until 1947 to from 1947 to 1990, India has been more of a socialist communist country. Rather than communist, it's more of a socialist country, and then we have been very closely uh, we were a kind of very closed economy, until for almost like 40 years there after our independence. So in 1990, we actually opened the doors to international investor base through liberalization, privatization, and globalization policies, and that's when we had like a lot of new age industries that came up. So if you see the wealth that got created in India, and the family offices that are being set up in India, now this is the wealth that has been created over the last 2 to 3 decades. Whether it is manufacturing, chemicals, the consumer goods. There are a bunch of industries that came up and they thrived and they prospered. So Indians started to consume. there's like a hardworking working class population, and uh, the industries thrive, right? So from 1990 to 2010, or I would say like, from 2000 to 2004 vintage period, we grew decently. We grew, almost at around like 5 to 6% GDP growth consistently, until 2004. And also until 2010, in around 2008, 2009, we had an interesting GDP growth of 8 to 9%, as a country. Coming back to the investments part, the reason why I want to divide this is to talk about the vintage periods. From 1990 to 2004, it has been more of the traditional investments that went into India, in the real estate, infrastructure, all these aspects. So from 2004 onwards is where, there has been a lot of, India kind of opened up, and there has been a lot of institutional and international funds started investing into India, and we saw the growth of alternative investments as a space. So we had the first, wave of private equity, from 2004 to around 2012 onwards. We could take the first vintage period, and from 2012 to 2019, you could call it as a second vintage period, and then 2020 onwards, there is this third vintage period that is getting started. So with regards to the exits, the first phase did not do that well with regards to the private equity. I have some statistics and numbers here. So there are decent returns, but with the 2012, 2013 vintage period is where the private equity actually generated a lot of returns. So the first phase, a couple of reasons, three reasons to point out, right? The promoter quality is not that great, then, and there were only very few deals that were available in the market. And also, India capital market system was not that matured, to provide exits, during that time frame. But things have changed over the last one decade. Going forward, what I would like to spend my time is, the changes that have happened in the last one decade and how India is progressing, and the opportunities that could be seen both from the institutional investors and for the family offices there. So the private equity guys have learned from the first cycle, and they started. Yeah,
Kieran,
sorry.
just noticing how many slides you have. You may want to keep rolling through.
Sure. Yeah, I'm getting to that. Yeah. So yeah, I think I'll quickly go through the slides. That's what I want to talk about the last decade. So the second decade, 2014 onwards, we have been, generating like a lot of returns, and there is like a lot of improvement in the promoter quality. Entrepreneurship is growing. Like we have Sanjay Mehta, who is a very prolific angel investor, joining us today. He will be discussing about his thesis. He has made like decent investments, and really made decent returns out of India. I think I'll shift the slides and then talk about macroeconomic factors, and then the future, from here on, from 2021 onwards, and what is in it for the private investors and for the family offices, to start looking into India. So there's no second thought. I think India will be a $10 trillion economy. We are at around like 2.5, 2.7 trillion as of today. So there is going to be massive amount of GDP and wealth creation that is going to happen in the country. What does it mean? Humongous amount of opportunities there in the country. So why is it happening? I'll come to that in a bit. So IMF estimates, these are IMF estimates, by the way, IMF estimates that India will grow at 11.5% in 2021, and whereas China will be growing at 8%. So India will have the fastest GDP growth in 2021, across the globe. I mean, no other country has, double-digit growth, as projected by IMF. The most important piece is, where the opportunities are coming is India is transitioning, into, we are a lower middle income country as of today. We will be transitioning from the lower middle to, middle income country by 2030. So that is going to happen in India, and how we are going to, drive there. We will be driven, the whole story is actually driven by, a couple of factors. One is the demographic dividend. So I'd like to show this slide. This actually, gives a better picture. So just marry these two slides, right? So the demographic dividend. So we are at 1.3 billion, 1.5 billion in 2030. The interesting factor is look at the median age. So the median age as of today is 27 years, in 2019, and the median age is not changing much. It's only 31.4 in 2030, whereas the median age in United States will be 40, and in China it will be 42, and China is already aging. And also the amount of the working population that you have by 2030 is humongous. We'll have close to 65% of the work, 65% of the population in the working age group. So that means the people have a lot of spending capacity, and they are looking for new innovative products and services. That means there is a growth for a lot of startups or a lot of companies to come into the India, or there is a lot of investment opportunities and where you can actually make a lot of money. So from the macroeconomic perspective, India is at a very stronger position there. So the demographic dividend, as I mentioned, let me quickly go through these slides. So now I'd like to talk about what has happened over the last 5 years, especially in India. Humongous amount of transformation. In 2015, Reliance, the Ambani, which is the richest man in Asia, he came into the market with his with Jio, which is a telecom provider, and that actually transformed India a lot. So most, and there is Xiaomi, from the China, which has connected it into the Indian market through their smartphones. So combined with that and Jio, the mobile penetration has surged like crazy in India now. Now, if you see in 2020, this is expected, but I think the number is very big. We have around close to 850 million smartphones, as of today in India, and you will be shocked to hear some of the interesting statistics there. So around, as I said, 720 to 750 million people have, the access to internet. And what does it mean? So people are actually, spending time on mobile phones. They're consuming a lot of content. They're actually shopping on mobile. They're doing commerce on mobile, and they're consuming content. They're actually shopping. They're actually ordering food on mobile. Everything is happening on mobile, literally. So if you see the daily video consumption, it's actually close to 2 to 3 hours of time is being spent on mobile video these days here in India. So this is the number of the digital buyers as of today. The population, it is very less, to be frank. So the e-commerce penetration is only close to, the GMV of e-commerce in India is, as of 2019, is only $30 billion. So it is actually expected to, grow 5x or 10x, by 2030. That means there's like a lot of digital buyers coming and buying on e-commerce through mobiles there in India. So I'd like to talk more about, what is in it for this group as per se, right? The family office group or the institutional group. So this transformation over the last 5 years have opened up humongous amount of opportunities for people, both for investors here in India and as well as abroad as well. So when you as a foreign investor are looking into India, there are humongous opportunities that have opened up in venture capital space. If you see, India today has 35 unicorns, and it is expected to have 100 plus unicorns in the next 4 to 5 years. And we will have 200 plus unicorns might be by 2030 or 2035. I'll let Sanjay and other investors speak about that number. But there is a humongous amount of transformation that is happening on the ground, and there's like a lot of investment that is going into the startup scene, and there is like a lot of opportunities for foreign investors, to come and play a role in that space, both in the direct investing as well as in the fund investing. How we are going to do that, that's up for a separate discussion. We can do a deep dive on that, but that's number one area where you can actually see a lot of capital flowing into India. So the second opportunity, obviously, private equity has generated humongous amounts of returns in the last vintage period, and the third cycle is getting started. And with the maturity of lot of deals that are there in the market, with the maturity of lot of promoters, interestingly, a lot of businesses are being overtaken by the next gen. If I have to talk from the family office jargon perspective, so these are the kids who studied in United States, London, who got exposed to the different securities, different markets, who are coming back and taking the family businesses. So they are open to private equity, operate companies coming and investing into their investing into their company, and then take their company from A to B, or A to Z there. So that's number two opportunity that you can see in India. And interestingly, I'm actually quite actively working with a Swiss family office. I'm actually quite actively working with the Swiss family office at this point of time on like a couple of pre-IPO opportunities. The reason why I'm saying pre-IPO opportunities is there are, from 2015, 2014 to 2020, there has been a lot of capital that flew into the venture space, and these companies are ripe for disruption. These companies are ripe for exit at this point of time. And if you follow the news, there are two companies: Zomato, which is one of the largest food delivery company, similar to the lines of DoorDash. And also there is Nykaa, which is the largest vertical beauty commerce company here in India. They announced their plans for an IPO in 2021. So as I mentioned before, there are 35 unicorns, and which is expected to go to 100. So the number one exit strategy path, could be apart from the strategic sale, is to go to a pre-IPO, and the exchange here, SEBI, which is equivalent to SEC, is changing rules, for the startups here in India to exit on the Indian market itself. So there are humongous opportunities, that are getting opened up for the private investors there in that space, the pre-IPO opportunities. So two more asset classes which are becoming very hot is the private debt and the private credit space, because with the zero interest rates, and there is no yield for fixed incomes available. So no yield that is coming out of the fixed income and the bonds. So there are a lot of opportunities coming up in the private debt and credit space. There are decent fund managers on the ground here who are giving around 13 to 15% returns, in those two, asset classes. So those are two areas that, that could be looked into as well. And of course, ESG as a space is becoming hot. I think India is a hotbed, for ESG. There has been a lot of experiments that have been done, and impact investing in ESG will continue to grow. And distressed assets, with the recent laws that came into the picture, I think there are like a lot of opportunities in the distressed assets itself. If you notice here, I haven't discussed anything about real estate or infrastructure per se here. We will deep dive a little further on real estate and infrastructure at a later point of stage. But when I'm working with the family offices, when I talk to the family offices, so one thing that we generally tell them is infrastructure is a long-term game, and I'm just trying to be candid here. If you really do not have a local partner on the ground, and if you really do not know how to navigate the scene in Delhi and have some political connections, it is really difficult to make money in India. So just be a little cautious on that if you are getting into the infrastructure space. Now, having said that, people have made like a lot of money there, but when you have these opportunities, just be weighing the options of these asset classes vis-a-vis the infrastructure. I'm not against it, but it takes a lot of time. So how do you navigate it? That's the most important piece. So the most important piece is actually for India to work to navigate and to invest into India, you need to have a local partner. Find a local partner who actually can help you with finding the right opportunities. Help you with the all the due diligence, operational, financial, and then risk due diligence. If you as a family office are coming and investing into India, you can either invest directly or invest to the funds. But like the general, when we work with a couple of families, we generally request the families to co-invest with other families to start with, understand the market, and then you can go direct, with whatever asset class you would like to. Interestingly, what is happening of late is most of the startups, that are in India are actually setting up shops in Singapore. So if you're concerned about the currency risk or the operational risk or the arbitration mechanisms or enforcement of contracts, so you can actually navigate through Singapore, which is the most preferred route these days. And I've been closely working with Singapore EDB to see how we can route more investments through Singapore into India. So rather than through the Mauritius route, so most of the startups you can actually they're setting up in Singapore. You can set up an entity in Singapore, which could be done in less than 2 to 3 days. Invest there, and you are secured both from the risk angle and other angles as well. And your investment could be deemed safe, if you are routing through Singapore rather than directly coming. If you have any issues there. And stop with this, so I think I'll actually stop here. I think I'm happy to take any questions to start with, and Matthew will deep dive here from the other folks.
Any questions for Karen before we move on to the panel? Covered a lot of ground.
Yeah, so this is just at the 30,000 foot high. We can.
Hey, Mark, I've got a quick question. It's Rob Colorini here.
You're frozen on the screen.
Yeah.
Rob?
I may have frozen up with the Wi-Fi.
Now I see you moving.
Yeah.
Go ahead.
Can you, Mark, can you hear me now? Okay,
Yep.
Great. Kieran, can you just, can you speak a little bit about BRICS? And, I think Mark may have mentioned earlier some of this emerging market, togetherness. Do you have an opinion on how BRICS has been, and do you see that being an effective medium in this
He's going in and out. Is BRICS still relevant, Karen?
I think I can touch on that. So I think my focus has been more on talking from how family offices can come and invest and how you guys can make money. BRICS is more of a political thing in nature. So BRICS started with a very good motive, and I think we made really good progress, as part of the group, but of late, with the geopolitical tensions that has happened with the China and in the region, especially with the South China Sea. By the way, TikTok is completely banned in India, and TikTok actually laid up their entire team. I've been talking with a couple of people, so they laid up the entire team and operations here in India. So there has been like numerous tensions that are happening in the region, especially with China. And China is aggressively moving ahead with the Silk Road route. They are closely working with Pakistan. They're giving like a lot of rather than freebies. They are sponsoring some of their road projects there. They are supporting railway projects. They're supporting numerous things. To make the Silk route happen, but unfortunately, that route is strategically a disadvantage for India. So BRICS as a net, as a conglomerate is very strong. But I think over a period of time, over the last couple of years, it has lost its relevance because of the geopolitical tensions at the moment.
Well, I think we're at the point we want to move on to the panel. Kieran, is that fair?
Sure. Yeah.
We're at the top of the hour, so we'll have time for Q&A after each panel and then as we go forward. Do you want to continue to navigate the slides, or do you want me to just keep it up?
I think this is good.
Okay. You want to introduce the panel then?
Sure. Okay. So so thanks everyone once again, who are joining, who just joined. Good morning. So this panel, what we'll do, we have a lot of experts who are investing in India, who had like a lot of experience investing into India, and then who are in India at the moment. So what we will do is we'll try to understand the asset classes that they're investing in, the opportunities in those particular asset classes, and you as a foreign family office or a institutional investor, how to navigate that particular market or the particular asset class. So we'll try to keep it very brief. And I think what we will do is, in terms of the format, we'll request all the panelists to introduce themselves, the work that they have been doing, and then we will deep dive into a couple of rounds of questions, and we will open the floor to Q&A. Sounds good. On that note, I think I'll request Jyoti to just give a brief about herself and the work you do.
Hello, everyone. Good morning, good evening. I am Jyoti Bhandari, and I'm founder and CEO of a multifamily office, Loak Capital, based out of New Delhi, India. And I also represent a private equity fund from Switzerland, and we are looking to acquire assets, especially ESG compliant and digitization in the region. So I've spent over 2 decades in capital markets in India, and I've prior to this venture, I had worked with leading national and international banks based out of India.
Thank you, Jyoti. On next, Monisha.
Good morning and good evening, everyone. My name is Monisha Odhani, and I am basically a finance professional, into the private banking space for 15 years now. And I've done my MBA in finance from Symbiosis Institute of Management from Pune. And I've been dealing with, most family offices. Sanctum is where I work, Sanctum Wealth Management, which is nothing but your Coutts India Private Banking, which is now changed to Sanctum Wealth Management via a management buyout, which happened, 4 years ago. And basically work with a couple of family offices at my role at Sanctum, and I manage about a couple of $1 billion for them. I am responsible for devising a proper strategy on asset allocation, and also do tactical allocation based on where markets are headed and what is the need of the hour. So that is what I do, and yeah, that is it about me.
Thank you. Thanks, Monisha. So Kuntal.
Yeah, thanks, Kiran, and thank you, Mark, for this opportunity. And unlike my previous panelist, I'm not an investment banker or investment advisor. I am a chartered accountant by qualification, and I have, in fact, advised many foreign funds, family offices, as well as many other corporates looking to set up their business in India, have helped them guide through the maze of Indian regulatory and complex rules. Ever-changing rules and interpretation make the investment decision into India a very serious affair. It's not something where one size fits all concept you can't apply there. We have seen a lot of tax controversies in and around investments into India. So I'm involved into this for past many years. And recently, I've seen that, especially in past year or so, I've seen that lot of interest in India for looking out the opportunities for investments in the infrastructure phase, in technology space, in pharma sector. I fully agree to what Kiran has said on the opportunities which India is providing for growth. And I'm personally quite convinced also on the appetite of Indian consumers as well as Indian entrepreneurs to take advantage of technology and the software space. So much so that I'm on my personal capacity, I am now motivated to launch my own technology platform, which is going to be catering to the needs of startup community as well as
So,
create some marketplace.
so
Yeah.
yeah, thanks, Kuntal. I mean, we'll deep dive further on that. So we have Saket also joining us today. So Saket, brief intro about you.
Sure. Hi, good morning, everyone. My name is Saket Narang. I head Steinberg India Advisors here in Mumbai. We are exclusive advisors to the Steinberg India Fund, which is a India-focused, long-only public markets fund. We have been running this fund for almost 10 years now. It's roughly $250 million in size. And we run a concentrated strategy focused on investing in high quality consumer businesses in India. Like Kiran had, in his opening presentation talked about the rising consumer discretionary incomes in India. We feel that given the strong demographic dividend and the high growth in India, many consumer discretionary categories will experience very sharp growth in the coming decade. And we try and find these businesses at one of the early stage of their life cycles and try and own them for long periods of time. So for example, currently in our portfolio, we own.
Sorry, Saket. I will deep dive further on that,
Okay, sure.
in a moment. Yeah, thanks for the intro there. So I think let me come to Monisha first, right? She said just like that, she manages billions of dollars of family office capital here. So I'd like to hear, Monisha, from you on, what are the trends, the family offices are seeing on the ground, both from the macro and microeconomic point of view. And so if we have to categorize the investment into short, medium, and long term, so what
Yeah.
are some of the asset classes that the family offices are looking on the ground at the moment?
Definitely. So when it comes to your short-term asset classes, which is between 6 months to about 2 years, you can definitely look at some selected stocks in public markets. You can look at, as you rightly pointed out in your introduction presentation, we can definitely look at some private debt, private credit. That is something where most families throughout the 2020s have made a decent return, which is in the range of between 9% to about 15%, depending upon the kind of credit and the kind of risk appetite these families have. So, we can definitely make a good money even in the short term. When it comes to medium term, we can look at, certain private equity ventures, which may be for 4 to 5 years kind of a scenario. Definitely public markets is always an asset for whatever your duration is. So I would definitely put in some allocation towards public markets, listed equity, even for a midterm. And for long term, really, I don't really advise any family to look at any fund or any instrument from a 10-year or a 7-year perspective, because environment is very dynamic. Your government policies keep changing. So it's advisable to look at every investment from a maximum 5-year to 6-year kind of a scenario. And maybe we can review that after 5 years and look how we need to change it or not. So that will be my thing. That is how I would place.
So when you said 5 years, which asset class are we targeting at? Because typically, if you're investing in a VC fund, you need to look at 7 to 10 year horizon, for the exits.
Most, you're right, you're right.
Similarly with the private equity. So when we speak with family offices, and so with regards to private credit and debt, people are quite comfortable investing into like 4 or 5 year horizon. But what specific funds or which asset classes are you specifically referring to?
For 5 year, you're talking about?
Yeah.
So you can, so your private equity funds or venture capital funds won't come at a 5 year duration. They are usually funds which are 10-year long funds or 8-year long funds. So you can pick up individual private equity deals or individual startups at right from seed capital to, maybe a pre-series A stage. We would prefer entering at pre-series A stage because what has happened is the startup has some amount of run up that has already happened. There is some bit of momentum that a promoter can already show to a family that what has he done with it. Coming at a seed capital stage is according to me is too nascent stage for any family to put money. And maybe so a pre-series A stage is a good stage to evaluate startups. And these are the kind of investments that one can typically choose. And there are a whole host of investments available. So we can, probably families need to do more due diligence on what they are comfortable with, the sectors that they truly understand, where their comfort lies, and what is it that they're looking at when they're doing the investment, whether it's more of a valuation game, whether it's that they're looking to be a strategic partner. So that are the decisions that families would need to make while evaluating these individual private equity deals, which would be from a 4-year to 5-year perspective. The sectors that most families like here are mostly right now is edtech, because a lot of technology is coming in the education space and most big names are after it. The another one, which is a good area, which probably lures most family, is the digitization of general trade, which is happening. And you will see right from Reliance Jio to your Airtel, everybody's in that game. And so are many, first-time startups also. So that's also something that's quite upcoming and something that most families like.
Yeah, thank you.
Apart from your
we'll further deep dive, both in this session and the next session on, the trends
sure.
that are happening in this space. So
Sure.
let me come to you, Jyoti. So what are some of the trends that you are seeing within your family office community? And so if a foreign investor to the group here, if they are looking to come to India, so of course it depends on the risk appetite. Like, what are like 1 or 2 asset classes that you would like to suggest?
Thank you, Kiran. And I would say your presentation was quite informative and you've covered pretty much, what we'd like to share. But I feel that what I have seen in family offices, I have interacted that, India has definitely emerged stronger, post-pandemic. And where we see, long-term growth coming or the trends emerging is especially e-commerce, which will result in a major shift in consumer behavior, electric vehicles, which will transform the auto industry globally, OTT to emerge as a major vehicle for content transmission, then green energy, another major portion, make in India, especially white goods, OEMs, chemicals, and financialization. We've seen, in fact, post-liberalization, now we are into 2 decades of liberalization. We have seen about, $500 billion of FDI in India has been the major beneficiary of FDI. And especially last year, we have seen, it's India who has gained most share in global FDI. So digitization, digital economy will play, the major trend in the next decade.
Cool, thank you. Yeah, absolutely. Can't continue more. So Kunal, let me come to you. Before asking my question, I wanted to share this information during the introductory thing. Um, Oh, okay. Mark is recording. So, since it is a closed group, right? I'm trying to be very candid here. Doing business in India is hard. Okay, let me say that. Of course, doing business in India is hard. Let me reverse my statement. In the last decade, but not in the first decade of the century, but not now. The reason is. There has been a lot of rules and regulations. There has been a lot of changes that the government brought in from 2014 onwards, which is actually protecting the investor interest of late. So when I spoke with a lot of investors back in New York, most of them have mentioned about enforcement of contract, enforcement of uh, uh, there is like lack of arbitration mechanism that doesn't exist in India. So there are like a couple of those complaints where investors have lost money. Uh, so I actually wanted to ask Kuntal on about the policies that Indian government has created to strengthen this investor ecosystem as of today, as of 2021. And say again, going back to the group here, if the group wants to come and invest into India, how are their investments protected in the first place? The most important piece is the principal needs to be protected, and if they find something fishy, they should have the ability to exit the portfolio company or exit the company there. How strong are those rules and regulations and the regulatory practices? And where is India going to evolve in terms of those structures into 2025?
Yeah, Kiran. So I'll try and address, in your this comment, there are many issues and many complicated questions there. So I'll try and address as much as I can in my capacity and ability.
It's a very loaded question. So let's try to keep it very strategic.
Sure. So if I was to talk about few of very bold and important amendments in India in past few years, which would be of great relevance and interest to the investors, would be the insolvency law. The way in which the government has gone about clearing the bottleneck of introducing a sound insolvency law. Now we have a law which is in place, and I think that is, I have personally experienced that it has given a huge fillip and confidence to investors when they look at an opportunity in India. That's one very big positive. Second, if I was to look at similar positive amendment, would be in the laws dealing with the arbitration in India. Earlier India was known to be a jurisdiction for luxury litigation when it came to arbitration. Even arbitration went on for about 8 years, 10 years without any conclusion on the proceedings. The only change was that it took place in 5-star hotels, in the chambers of big law firms, rather than taking place in the courtrooms. But now we have seen that in past few years, there has been a complete overhaul to the Indian arbitration rules, Indian arbitration procedures. Most important is that now under the law, it is possible to demand an interim relief, because if the issue involved or the demand involved has some kind of a perishability or some kind of urgency, then the the arbitration bench is allowed to issue an interim award. In any case, it has been provided that any arbitration referred to the tribunal or to the arbitrator have to be resolved in 18 months period. So that's a very big decision and big change. Also, the arbitration award now is equivalent to a high court decree. So earlier we had witnessed that even after an arbitration award, you'll see parties going to the court and challenging the finding of the arbitrator and making the whole exercise fruitless. But that is not there now. It is equivalent to high court decree, unless there are some prima facie errors. There are certain fundamental errors in reaching to the decision. Of course, one can have a stay in that regard. Otherwise, you will not see that kind of situation for arbitration award. So this is a very big thing when it comes to investment into India. Third, we have seen a lot of discussion and also fear emerging in the minds of foreign investment community with regard to the retrospective introduction of the law. Like we all know the Vodafone case and the retrospective amendment to the income tax law. Since 2014, we have seen that the present government has, even on the floor of parliament, as well as at other forums, made it very clear that there will not be any more retrospective tax law. So that's something very good for investors to know. But at the same time, there are many amendments. There are many changes which have taken place even in the tax front, which has given a lot of discomfort to the investor community. But I think that we can take it up at a later stage. But just to answer to your question, these are the two major changes in the regulatory framework, which can surely give some confidence and comfort to investor community. If there is any particular aspect from your comment you want me to address, I'll be happy to address that.
No, I think this is really great. So I think from the regulatory perspective, I think we are making the country more investor friendly, and I think we are pro investors, of late. And I think still there are a lot of changes to be made, and I think we are moving at a very aggressive pace and making it highly investor friendly. So thanks to that. So Saket, let me come to you. So you briefly mentioned about investing into finding and choosing the consumer companies there. As I mentioned before, right, we will be moving from the lower middle class to the middle income class economy by 2030. So from your perspective, what are some of the trends that you are seeing, and which industries are going to benefit from this consumption? And again, I am going asking the same question again for the investor base here. What are some of the recommendations, on a broader level? What are some of the recommendations of the industries that they should look into?
Sure. So I think if you look at the experience in other markets, whether it is in the US or in the last couple of decades in China or other emerging markets, what we have seen is that when a country sees its per capita income increase from, let's say, $1,000 to $5,000, it is the consumer discretionary categories which benefit disproportionately. Because after consuming the staples, the basics that the individual needs, the incremental income they generate is spent on better clothing, better food, better holidays. So I think consumer discretionary sector is something that we believe would disproportionately benefit. Within that sort of segment, there are many themes that one can look at. One could be branded apparel companies. Another could be restaurant businesses. And similarly, even entertainment and leisure, it could be amusement parks or, things like that. So I think these are the sectors which will disproportionately benefit. And we have seen this play out not just in the US in the last century, but also in China in the last couple of decades. And a lot of these sectors are very nascent in their evolution in India. So let's take the example of the restaurant industry. Recently, we invested in Burger King's master franchise in India, which went public in November last year. Burger King in India currently only has 250 restaurants, whereas in US they will have more than 2,000 restaurants. So we believe over the next decade it can be close to 1,000 restaurants in India. So your business can grow almost 4 to 5-fold in the coming decade or so. And like that, there are many such examples of industries which will benefit from this consumer discretionary income rise. And we try and sort of position our portfolio to benefit from some of these trends.
Sorry, I was on mute. Yeah, absolutely. Thank you. Thanks for that insight. just to add to what Saket mentioned, I was actually doing the research on the number of SKUs that are available in India for people to consume. Interestingly, so there are only close to 200, I think 220 to 250 million SKUs that are available in India, either whether it is made in India or we import from other countries as well. But whereas China has close to 1 billion SKUs. So the amount of consumption capacity there in China is almost fourfold or fivefold because of the availability, at the same time the manufacturing capacity that they have. To Saket's point, just to add to that, there has been a lot of D2C consumer brands that are coming up in India, which are actually being embraced by the venture capitalists. There has been a lot of capital that flow into a lot of D2C startups, which are doing really well, exceedingly well. And I think that trend is going to grow big in the next couple of, in the next years to come. With the consumption capacity that people have, they're looking for new choices. Especially the Gen Zs, they want newer opportunities and newer varieties. So there is a humongous scope. If you are in the space, come explore India. Is what I would say. Yeah.
If I can maybe, Kiran, add one more point here. That if you look at, the experience in the US or China in the last decade or two, a lot of wealth in public markets has been created by the technology, consumer tech businesses, whether it is the FANG stocks in the US context, or, companies like Tencent, Alibaba, Baidu in China. Like you mentioned, in India, there are 35 unicorns, which are, consumer tech firms, which have been funded. They're $1 billion plus in valuation, but all of them currently are in the private equity domain, where you can get exposure to those businesses only through a venture capital or a private equity fund. What will change in the next 12 to 18 months in India is that a lot of these unicorns will go public in India or in other exchanges around the world. And we believe that the consumer tech play, which has been a big wealth creator in US and China, will also play out in India. And I think this will become more a public market play going forward in the next decade than the sort of VC world that we have seen in the previous sort of 8 to 10 years.
Yeah, absolutely. Wealth creation happening with IPO market. Yeah. So I think we'll start kind of the second round. So Monisha, let me come to you. So you work on, we briefly discussed on the VC opportunities and the startup opportunities as well. So you work in the real estate space as well.
Yes.
So what are the trends that you're seeing in the real estate per se, in India, in the post-pandemic world?
Okay, so first of all, post-pandemic world is quite different from the pre-COVID world. As you also rightly pointed out in the previous session, government is helping investors a lot by bringing in new policies, by bringing in new regulations. So rightly so has happened with real estate sector as well. When you see residential sector, we have a new regulatory body now, which is real estate regulatory body called RERA. Now, with the coming in of RERA, there has been a lot of stabilization which has happened in the real estate segment as such, which was not available to investors earlier. Everything would happen at whims and fancies of a developer, but that's not the case now. Commercial is not a very attractive asset class right now. Primarily so because of yield compression which happens in any asset class. So currently your commercial is undergoing a yield compression. Also, during pandemic, what has happened is a lot of financial institutions, consultancy, law firms have moved their entire work culture to work from home. and which is also reflected in your REITs that are listed on the public market. The distribution yields for most REITs have gone down by 1 to 2%, only because most offices have given up on their leases and given up on their office places. So right now is not a time where I feel families should look at commercial real estate. Resi doesn't give you a great yield from investment perspective. It gives you about 3 to 4 odd percent. What has also emerged in your because of pandemic and because of consumerism, and the entire ordering from online and the new trends that have emerged after pandemic, a new asset class has gained a lot of momentum, which is your industrial real estate or your logistics warehouse. Logistics parks have primarily gained a big momentum due to many factors. Now, one is your changed consumer behavior. A lot of online ordering is happening post pandemic, which was not happening earlier in India. Your regulatory requirements have changed, and government wants to really emphasize on this sector. And so how is it doing so? By moving unorganized to grade A. There's a lot of unorganized warehousing stock which is available, and because of the new regulations, they no more can continue being unorganized. They've been forced to move to a proper grade A warehouse. In absence of that, there are statutory penalties. Third, I would like to say the turnaround time or a turnaround cycle for a logistics park, right from doing a due diligence on a land to leasing it out, construction of a warehouse and doing an exit is about 4 years. While similar case, if I were to take for a resi or for a commercial real estate, the project entire turnaround time, from due diligence to exit would be about 6-7 years. So that again makes your logistics more favorable than the other two asset classes. There are many drivers to industrial real estate apart from what I've mentioned. Like, you rightly pointed out, we are going to be 1 billion Indian internet users by 2030. And right now we are the second largest Indian market globally. And that is rapidly changing because of the changed behavior and, the data cost or the data prices have been reduced by 95% since 2014. The other interesting fact, if you see right now, the online retail penetration for India is just 3%. While if I were to take the same number for US, it's about 20%. If I were to take the same number for China, it's 26%. While if you look at Thailand and Malaysia, it's about 2% and 3% respectively. So there is a huge scope. There is about $4 billion, which has already come in through global institution like your CPPIB, your Blackstones.
Cool. Yeah. Hey, Monisha. Thank you. I mean, I think just to add to Monisha's point, right? I think three primary asset classes are emerging in India. In the real estate space, if you're looking into that, one I think is warehousing and logistics, as Monisha rightly pointed out, and which by the way, is poised to generate you very good yield. To I think early to mid teens. And the second area is the cold storage, and the third area is data centers. So if any of your families or investor base is looking into these three asset classes, I think there is a humongous scope again. We are at a very, very early, nascent stages, and I think there's a lot of scope, in these three primary asset classes. Yeah.
Definitely.
So, sure. Thank you, Monisha. I think on
Kiran,
that
I'd like to add one more point. Yeah, I'd like to add one more point to real estate. Like we spoke about, housing, definitely they don't yield as well, as other asset classes are yielding to family offices. But due to work from home economy and, savings that, double income families made, so we have recently seen quite a demand on the residential side. So So there could be additional, as a result, there's a high demand for housing ancillary industries like cement, steel, electrical, accessories, paints. So which could, which family offices could look at either through public markets or, pre-IPO series stage.
Sure, absolutely. Good, thank you. So I think we are running out of time, so I just want to cover two more questions. So Kuntal, let me come to you, right? So we briefly touched on how the regulatory environment is changing here in India. So if you have to advise, the group on how to navigate or how to invest into the Indian market, again, I'm trying to ask so many loaded questions here. So what are three factors that you would, three things to keep in mind, are three things that the investor base should navigate uh, or keep in mind while investing into India?
Yeah, so I think you are right. It's a very loaded question. I'll try and do justice to the question which you have placed for me. If I was to look at three fundamental points which investors should be mindful of when they are looking to invest in India, one would be to minimize the limiting the liability, ring fencing the head office situated outside of India from their investment into India. That's the first key point which I would look into. Second would be, I would be looking at the structuring of my investment strategy. That is, in what route I will enter India, whether it would be a direct FDI investment or whether it is going to be through a fund structure, whether I'm going to use any other jurisdiction in comparison to the jurisdiction where head office is situated or the holding company is situated. And third would be, what is the best way to minimize the tax liability on repatriation of the income or the gain, which one would make after having successfully identified the opportunity and then looking to exit from India. So these are the three fundamental points which I would look into.
No, that's great. Thank you. Thank you so much. We almost ran out of time, but with Mark's permission, I'll just go around the screen. And I think I'll start with Saket. Saket, just brief, 30 seconds. So let me put it this way. I don't have $1 million. How much should I give? Okay, let's say I'm giving you $500,000 as of today. Which asset classes would you like to invest in India? Where would you like to bet? And the bullish sectors for the next 2 to 5 years.
I think if you look at India, apart from the fact that we are recovering from the pandemic, India is also going through a very strong cyclical recovery. And we believe that small and mid-cap equities generally tend to do well in a cyclical recovery. So I would put all my money in small and mid-cap public equities.
Oh, no diversification?
No, I think for at least for next 2-3 years, we would be comfortable owning. I mean, you can build a portfolio in public equities and have diversification across sectors. But I think small and mid caps, which have sort of underperformed over the last 3 years, probably look the best bait to play this cyclical recovery.
Okay, Jyoti, same question.
So I would also go with Saket on that. I'll look at small and mid-cap public equities. I would also look at some pre-IPO opportunities in the consumption space. Like I said, housing ancillaries. So that would be my bet. And apart from financial performance and long-term, investment objective, I would also look at sustainability as a key factor of my investment decision.
Perfect. Okay. Same question to Manisha, but not the same answers, please.
Yeah,
You want new
absolutely.
sectors? Yeah.
Absolutely. No, it really depends upon your risk appetite and a lot of other things before we construct a portfolio. So there can't be like one bill that fits everyone. But however, if I were to deploy it in the way I would do my personal investments, is something that I would definitely go for public markets. You cannot really avoid listed equity in a portfolio. So, and mid cap and small cap have had their good share and good rally in your recent past. So there definitely is a case to have some bit of investments there. But having said that, one should also look at some amount of structured credit, structured debt, and again, private equity would depend upon a lot of other parameters. So I would personally would do a more evaluation than decides something which is spur of the moment. So yes, I would probably look at structured debt, structured credit, and some amount of your listed stocks.
Perfect. Okay. So since Kuntal is from Mark and tapping Kuntal is not from the investing background. So one piece of advice for foreign investors to enter into India, or let's say, 30 seconds.
No, I think I will. My advice would be to be very absolutely clear on their entry strategy, keeping in mind the duration of their exposure to India, and also keeping in mind in what form they would like to realize their gains or returns from investment. Because there is always a good opportunity, but unless you make it worthwhile for you by structuring your entry strategy, I think it will not be efficient and you will not get the right return on your investment.
Perfect. Thank you. I think on that note, I'd really like to thank all the panelists before, and thank you so much. Those were very solid insights and pragmatic insights, and thanks once again.
Thank you so much.
Thank you for having us.
Thank you, Kiran and Mark. Thank you. It was great to be here.
Thank you, Kiran. Thank you, Mark.
Yeah, thank you, Kiran and Mark, for this opportunity.
No, it's everyone. Thank you. So I think, moving on, I think we'll quickly move on to the next panel. So as I always tell, I think diversification, differentiation, and liquidity is your mantra for success, right? So from the first panel, I think the consensus was public equities and the structured credit. I'm sure I can bring a different set of opinion from the next set of panelists here, because they've been deeply invested in the technology space, in the VC. They are venture capitalists themselves. They have generated exponential returns for themselves and for the funds. So without further ado, let me get started with the introductions. We'll go first to Sanjay. Sanjay, a brief intro about you, the work you do.
Sure. Thanks, Kiran. Thank you so much. So we are part of Mehta Ventures family office, and I run across 100x.vc, which is a first check venture fund. We have invested in 39 deals in last 1 year. And through Mehta Ventures, we invest across the globe. 100x.vc is a SEBI registered fund. We invest only in Indian startups. Personally, through the family office, we have invested over 150 odd companies. And angel investing has been very rewarding early stage. Our IRR has been upwards of 100% cash on cash, and 2 unicorns in the portfolio. So it's been a great journey last 11 years investing in startups.
Awesome. Just to intro about Sanjay as well, sorry, forgot to mention. So he has been rewarded a Hall of Fame by TIE, and I'm sure most of you have heard of TIE. So they have rewarded Sanjay the Hall of Fame in 2020. I think I was in Mumbai then, Sanjay. So moving on, Akash, brief intro about you.
Thank you, Kiran. Hi, guys. So I am basically very vested and deeply entrenched in the startup ecosystem. I've been a founder since 2014-15. I had an online grocery delivery company called Doodhwala, which we eventually exited in 2019. Following which I joined Earlsfield as an investor, and we are predominantly a growth stage Series A to Series B investor focused on technology companies. The idea is to focus more so on companies which are catering to large sectors, large mass sectors, and sorting inefficiencies. Like we all know, emerging markets are essentially full of inefficiencies across the board. And the idea is that inefficiencies, although they create jobs, they do have yet lesser yield and higher costs. So as far as we're concerned, we're looking for companies which basically use technology to remove these inefficiencies and in effect create large companies with strong business fundamentals and large profit pools.
Awesome, thank you. So Kumaran, brief intro about you and the work that you do.
Thanks, Kiran. So I'm a portfolio manager who's been into the investment space for more than 15 years. Manage AUM of close to about $1 billion across platforms and across asset classes, be it infra, real estate, or so. And my current students, we've established and set up an alternative investment platform with the emergence of AIF, which has been in India only in the past 3, 4, 5, 6 years. So set up for a multi-billion-dollar conglomerate in India and running it successfully, which is again yielding in the range of 15 to 18%, predominantly into real estate space.
Sorry, cool, thank you. So we have Amish also joining us. So hey Amish, brief intro about you, the work that you do, please.
Yeah, sure. Thanks, Kiran. Thanks, Mark, for having the opportunity. Hello, everyone. I'm Amish Chalandwala, Managing Director at Complex Capital. I've been based in New York since 2000, having a diversified experience across capital raising and corporate consulting, which I've specialized. I look at 3 markets: US, Pan Asia, and India. And within those, I try and raise capital for private equity and venture fund managers and opportunities of private companies, as well as I provide corporate consulting to US-India corridor companies which want to expand and scale geographically, globally.
Awesome. US-India corridor is something that I closely work and I'm still trying to work. I think I have like a lot of questions, so we'll come to that in a bit. So
Sure.
Yeah, Sanjay. So let me start with you. So you've been a very prolific angel investor. Made exceedingly exponential good returns in the Indian space. So just brief us about as a country, where are we at the moment with regards to the startup scene? And going back to my same question again, for the foreign investors who are looking to come and invest into India, so where should they start? Where should they start looking into the opportunities? So someone sitting in New York, how should they start looking into the opportunities, and then how should they start deploying capital? Sanjay, you're on mute.
Yeah, sorry, I was on mute. So I think, Kiran, a lot of opportunities from a perspective for startup ecosystem, alternative investments. We have a robust, ecosystem in India, almost like 12,000 plus startups, which has been created across in last 1 year, 2020. Even with pandemic, we added across 1,600 plus startups. We added 12 unicorns in 2020. Total now 38 unicorns in India. We are $3.5 billion in between Jan to December in 2020, which got received across invested. Now we have a corporate venture capital which is investing into India, and around 500 plus active incubators which are there, and 300 plus active institutional investors which are there, kind of. So India, key trends which I would say across, which strengthens the India's startup ecosystem. One, we have an accelerated digital economy. Thanks to Jio, things have changed drastically in last 1 or 2 years, if I have to say. And pandemic created a shift in the founders playbook. Now world is at their feet. They can work across and scale business globally. That's the vision. Deep tech is really taking deep roots in India. Amazing deep tech companies are really coming across. India is now home of unicorns, kind of stuff, and strong investor commitment. Domestic capital is growing in multi-folds kind of stuff, and consistent corporate participation. I think that's a big thumbs up which has happened in last 2-3 years. And new startup hubs are getting created across in various cities, small cities, tier 2, tier 3 towns, and that active participation is changing. Totally, we funded 881 deals in India. Active investors were around 1,476. Top 3 sectors were edtech, fintech, and food tech. In terms of the funding amount, and in terms of the number of deals which happened across last year was fintech, edtech, and health tech. Bangalore still takes away the largest chunk, followed by Delhi and then by the Mumbai in terms of the number of deals which are happening across. So, I mean, we are going to see across flurry of IPOs happening across with startups in India getting across listed. That trend is going to change many things for startup ecosystem in India. So it's a huge opportunity and a market. Today also, if you look into the e-commerce market, which is has been the poster boy for everything, huge opportunity. We are still only going to be 11% of the total retail market in 2025. So we are right now only around 4% kind of stuff. And D2C brands are growing rapidly. I mean, there are so many brands which are now 100 crore direct to consumer brands, which has been created across in India. So if you look into the affluent class, the elite class, those were not just the only target focus. Now we've got the next billion and aspirers, which are joining that, buyers pool. So that's, I would say, across on the India story. Hope it helps.
Absolutely. Thank you. Thank you so much for the macro perspective. Going back to my another question, right, Sanjay? So say if someone is sitting in New York or someone is sitting in Texas or Silicon Valley, and if they would like to come and navigate the Indian market, or if they would like to capture some of these opportunities there and ride the wave of the India's growth story, where should they start? How should they start looking into deploying capital, or what is the starting point for that?
I think the best starting point would be working with some fund manager, getting hands around the whole market, understanding the lay of the land. There are quite a lot of angel networks which are available for anybody to join. If you want to do angel investing, try to put small checks. But I think the best bet would be working with any fund manager and taking fund into various funds which have been very successful in India. Quite a lot of funds have been, while we hear stories about, funds not returning capital to LPs, in India, the story is different. It has been quite a lot of successful funds which has given fantastic returns to their LPs. So while we at 100x.vc, just as a disclaimer, we don't do third-party capital. We just invest our prop capital of family. But there are quite a lot of funds. Anybody needing help, happy to introduce.
Thank you. Good. So let me come to you, Akash. So you worked, you're working with this VC fund, which is at the London India corridor, right? So you do investments both in London and India. So what are some of the trends that you are looking or you are picking in India, and so some of the sectors that investors has to be invested in the next 2 to 5 years?
Sure. So I think taking off from what Sanjay said, he summed up pretty beautifully the Indian landscape. The way we look at India, of course, given sort of on the backdrop of what's happened with over the last 4 years, right? We've seen movement in the last 4 years that we haven't seen in the last, I'd say, about 14 years. And that's fundamentally because of the infrastructure that was established, right? We're talking about 700 million people on mobile internet right now. And this is almost twice the population of the United States. So you've generally got India, which has now become digitized. And that's a big plus because you suddenly are not talking about getting people online. They're already there, right? So that's one. Even something like, content consumption. If you look at sort of per user data consumption per month, it's gone up almost 13, 14x. It's about 15 GB per month per user right now. that just basically shows you that India essentially is either transacting online or consuming online. And right, and given how fragmented we all are, this is happening across various different languages. And that's quite interesting because that much opportunity is left for startup founders to actually create innovative solutions out there. The way we evaluate the new startup landscape, and why I call it new, is because we're pretty much in startup 2.0. Startup 1.0, which you'll obviously know about, that's Flipkart, BigBasket, and the likes. These guys essentially spend a majority of their resources and time just getting people to transact online. First come online and then transact online and make payments online. And that's why you had sort of logistics and you had payments, and all of these things really become the prime focus for all of these companies. So it was basically about getting consumers online and making the most of the scale that India had to offer. Now startup 2.0 is a little different. Companies don't spend that much time and resources. If they have the right product, if they have the right customer experience, consumers will flock on, right? So I think that's a given. Essentially, the way we analyze the space is that which companies can now form large companies in their own rights with very massive profit pools, right? So ARPU is a concern. It's always been. We're pretty aware that Facebooks and Googles of the world essentially currently look at India as a DAU and an MAU play. What remains to be seen is how these companies actually evolve to becoming large profitable entities by themselves. And that's what pretty much we're here to do, right? So we hope to use sort of our experience, our network across the board, and just to help founders and help companies attain that scale and make the most of that scale by getting their ARPUs up, getting their sort of profit pools intact. And I think that's pretty much the next sort of war that's going to be on the India turf. And we're seeing pretty positive signs. I think, especially after the pandemic, you've seen a lot of companies that have actually, come out and really streamlined their financials, right? They focused less on spending and marketing. They focused more on customer experience. They focused more on retention. And I think these metrics bode very well for the ecosystem in general, because that just shows the kind of focus that's being given to the formulation of larger entities, which are sort of self-sustainable. And I think essentially that's what it's about, right? No investor, I think at least as far as we're concerned, we're very founder focused. We are founders. We're not looking at M&As and getting acquired as an exit route for us, right? So for us, can the company have a large enough cash balance in the next 5, 10, 15 years such that they can essentially buy off the stake of existing investors, right? And that would be sort of the optimal exit scenario for any investor, right? Because you've really created something purposeful and meaningful. So that's pretty much the way we at Earlsfield look at the entire ecosystem.
Can I ask a quick question? You mentioned founders and taking money or exits. What does the secondary market look like inside India today?
The secondary market is in fact something that we as a fund are quite excited about. So although we are an early stage fund, we keep having conversations with our limited partners and sort of fellow investors as to how we can make the most of what's happening with Startup 2.0. So, right, so you have, say, a Zomato or a Policybazaar, all of these companies going in for an IPO over the next 6 to 12 months. And that's really going to set the benchmark for secondary transactions somewhere, because when it comes to secondaries, it's sort of firms looking to buy out ESOPs, firms looking to buy out earlier investors, take common stocks into companies. And the only thing which entices such funds is that there is an exit down the horizon, right? So they're not really investing for the life cycle of the entire company. They're looking at a 3 to maximum 5-year investment where they get to recoup about 3 to 4x. So secondaries is going to be something which will get a lot more focus now. And we already know of a couple of investors, and we've been speaking to them, and they're showing a lot of interest and enthusiasm as far as the secondary market is concerned. So that's definitely something which will really explode once we have a couple of successful IPOs, which, by the way, hasn't happened till date, right? So we've had very, very few IPOs, and a couple of these companies really going and getting valued at $5 billion, $8 billion, which is what Zomato is actually expecting. That should really open the floodgates.
Actually, just quick comment, to what Akash said, right? So the secondary market is actually active with regards to the old economy market already. So when I meant by old economy, the manufacturing companies or petrochemical companies, the secondary market has been active, and there are like a lot of funds, who are playing the game. when it comes to the new age economy and the new age companies, internet, economy companies, as Akash rightly pointed out, it is picking up a lot. I think we will, I on a personal note, I'm very bullish, and I think we will see a lot of trends coming in the space. It's just that there is something that has to be done on the regulatory side as well, which is being worked on at the moment. But I think overall the market is very bullish. I think let me move to Amish and then I'll come to Kumaran. So Amish, so you work on the US-India corridor. So when you work with investors, in New York or United States, so what is the viewpoint of India, or what are the bullish about and what are the concerned about, and
Yes,
also and also the sectors generally the investors look into as of today into India.
So see, India is one of the largest populous markets after China. And I think what I say over the last 5 years that I've been saying, it's the country that's time has come. So India is the country whose time has come. Now, you can slice and dice it in many different ways. Family offices and institutions look at with one view, whereas the retail investors globally look India slightly differently. So when I have conversations with global investors, it's always a starting point. Is it the first time they are coming into India? Do they want to come in more for a shorter lifespan or a long-term relationship? And that really defines the public markets versus private. And if they are ready to take more investment risk, what Sanjay mentioned and Akash, that's kind of where I think the ecosystem in the venture and the private equity has kind of more or less matured in the last 10 years. We're still nascent, I would say, but there's a lot of activity happening, and the VC market is now probably the third largest behind Silicon Valley and China. So certainly, I think I say it again, India is the country whose time has come. One has to be cautious. We had earlier one of them speak about the tax rebates and kind of the retrospect impact, right? So all of those uncertainties, I think pick any emerging markets, you would see those sort of uncertainty elements and kind of the maturing and fine-tuning of the policies. But within that, always can you look at places, opportunities for money. As Sanjay mentioned, I think for somebody who's new to India, the best bet would be to look for either a listed space manager who's good at, let's say, across small, mid-cap and large cap. And same in the private equity venture, if there is a manager that they can identify, certainly that is a good point to start. Unlike US and China, we don't see a lot of fund of funds on India, which probably is one layer above any of these. But there are a couple of them, and I don't think the fund of fund market in India is likely to rise. But certainly the manager routes on public markets, private markets, both could be a good, interesting way to start in that space. And of course, the caution one would always need to see is the FX risk and the loss on rupee, which traditionally is about 3% over the historical period that we have seen.
Absolutely. I think there are decent hedging mechanisms in that some of the fund managers that do, execute while putting a fund together. So I agree. Yeah, 3 to 4% needs to be accounted into whenever you are looking into emerging economies there. Yeah. So Kumaran, let me come to you. So you invest in real estate, and then you've been doing like a lot of structured credit of late. So what are some of the trends that you are seeing in that space, and any pointers for the audience here?
Sure. Thanks, Kiran. So in alternative space, real estate occupies more or less almost 70% of the space. I mean, that's predominantly because it was earlier in equity. Now it's slowly moving to the structured credit with all the experiences of earlier past ones. So the structured credit is nothing but a combination of an equity with a flavor of debt, whereas you're just arresting you're making sure that you're getting exit within that certain tenor. And there is a exit strategy which is already formed at the time of investment. And there is a correct set framework and the path to exit is there. So that's all the structured credit as one. And of course, since it's a senior and more secured, people prefer this. That's how, if you can see, even in real estate, say in earlier 2000s, there were a lot of few private equity plays which comes in now, it's slowly turning towards the structured credit. So such evolution is happening, one, and it's happening for a reason, predominantly. And two, structured credit also ensures, I mean, the structured credit is now getting into a place where it's coming into at various stages of the investment. It is not just early stage and wait till the life cycle of the project or life cycle of the asset to throw you the investment back with returns. It's like, say, come into stage 1 or come into stage 2 or come into stage 3. It could be a mid stage or it could be a early stage or a late stage, depending upon the risk appetite, depending upon your levels of conviction on the product. So that's happening because earlier structured credit was happening only in the early stage of the investments where the risks were a little higher. But now it's becoming possible. Of course, the capital, the liquidity, which is there's a false sense of liquidity in India. The capital market in India currently is not that great because, especially in the credit space, banks are holding a lot of liquidity, but it's not flowing into the corporates much. That's creating a vacuum. So that's where the structured credit is occupying and then filling into the shoes, trying to give a focused attention to these needs. So that is slowly going up and has also tried to bring in more investor confidence on such investments, even cross-border or internally as well, more from an institutional point of view or from a, say, family office or a individual retail investors point of view. So this is happening and yeah.
Sure, thank you. I mean, so what kind of yields someone can look into this particular?
So structured credit, as I said, since it's moving more closer to the less risk and more definite returns. So it ranges from in India at a gross level, it ranges from anywhere between 15 to 20%. So it depends on at what stage you take the risk. This is at a gross level, pre-tax and pre-expenses might be closer to around, still it will be a double digit in India level, which is decent for now. And thanks to, as Jyoti and Manisha pointed out, the RERA and other regulatory reforms have made this exit easier, one, and monitoring or even managing this investment easier across the platforms. So that brings in from this. Yeah.
Cool. So one follow-up on that. So say again, if someone wants to come and invest, what is the best preferred route and where should they start?
Okay, I'll again look back to give you an experience of the past so that we can look front. See, what earlier happened was in the early or in the mid 2000s, there were private equity who were straight away coming and investing, or the global players who straight away coming and investing in the directly the developers or the promoters of the companies who were directly into the investment space or into the development space. So what went wrong was because the developers had very little control over the other aspects like approval, land, and other litigations aspects. And since they were directly investing into the company, they had to rely on the ground to the company for the information or to manage all the litigation aspects. So that has made them to learn the experience. So now the right route would be to have a managing partner here who will try to assess the risk, one, and try to address the exact needs and try to match the appetite along with the risk levels. So that would be the right mode rather than investing at an entity level to in a rush to get more returns.
Got it. Okay. So find a local partner who understands the risk, who can analyze the risk, who can do the DD for you, and
to diversify per se. Yes.
Help you invest, based on the risk appetite. Thank you. Thank you so much. So Sanjay, coming to you, right? So you have done like a lot of investments in India and then US and in the corridor itself. So what are some of the sectors that you're bullish on? Number one, and number two, as with any investments, investment is subjected to risk. So what are some of the pitfalls that you have seen and you would recommend the investors here to take care of while investing into this particular asset class?
Sure, happy to share that, Kiran. So basically, in the current, sectors trends keep on changing. What we are currently seeing across and where we are working very closely to invest across is with the Indian market, is where we are seeing future of work, remote technologies, anything which is driving home economy, what is working across on safety, cleanliness, sanitization, health, hygiene, wellness. Deep tech, AI, SaaS remains a favorite, evergreen. Agri-tech is growing very rapidly within the portfolio. So I think these are a couple of sectors which are very, very interesting for us. In terms of things which we are not closely looking is travel, tourism, hospitality. We are avoiding anything which is luxury goods, jewelry, apparel kind of stuff. Real estate, any training classes, coaching classes, we are avoiding. Retail tech is something what we are avoiding. So these are the sectors which are there, which we are looking closely and monitoring them on a regular basis. On the risk side, the way I see across, Kiran, and my understanding is, in the startup world, risk is 1x, your upside is unlimited. This is the only asset class where you can actually influence an outcome. Today, for example, you buy real estate, listed equities, any of this, you can't influence the price movements or anything to that. You buy across stock of Reliance, you will not be able to influence the price. But when you work with startups, this is like a primary investment going into the company, and you work closely, you can actually work and give the startup a direction and influence an outcome. So I feel this is the safest asset class which anybody can invest into. You need to think this as a proper business, and the upside is unlimited. You can't think across 1000x, 3000x kind of stuff in listed equity. In startups, those are all things which are possible, right? And we always look upon, we focus on not the frequency of our correctness. We will fail multiple times. This is not real estate where we want to be right every time we invest. We don't focus on frequency of correctness, but we see the magnitude of our correctness, right? So power law comes at play when we invest in startups. We don't invest into a startup because it will not fail. We invest in startups because if it becomes right, how big it will be, how world-changing that startup would be. And 5% of the deals actually define success. So I mean, that's the thesis which has made our investing very, very successful. We will look for all the moonshots, and we just go for that. Every deal we look individually, and every time we look for an outlier hit kind of stuff.
Awesome. Yeah, it is the power of luck, as you rightly said, in this particular asset class. So Akash, same question to you, but so what sectors are you bullish on? What sectors are you looking, from the fund perspective? And for a foreign investor, to invest along with you, so what is the best preferred route that you would suggest?
So I think I'll take the second question first. Like everyone pointed out, there truly is only one way to navigate India, and that is especially as far as the new economy, which is the technology space, is concerned. And that is to essentially be very directly involved, right? So you can't, India is such a large and complex economy, population, country, that you can't really have something which has worked elsewhere work here, and sort of, those copycat models. And we've seen that across the board, right? We've seen it in various different segments, that the localization that's present here is to another level, right? So you need someone who really understands how localized every single product, every single company needs to be, how fragmented the market is, how different and varied consumer behavior is. And that's pretty much game changing. I mean, even in China, if you see, China pretty much has one standard sort of scale formula which can actually work, because it's not that diverse a country. And pretty much like every other country out there, not like India, right? India is literally 20, 25, 30 odd countries fit in one. So we've got to, so you can't expect someone to really invest in India not being very deeply entrenched. You need to either have a team, like in our case, we have a fully focused India-centric team based out of here. Everyone in our team has experience from the ecosystem and understands companies and products tailor-made for the subcontinent. So I think either you have a direct team which is really focused and has the experience, or you partner with investors and you co-invest with investors who have an India presence and a strong India presence. I think there's no two ways about that, right? So it would be a little callous to actually go invest in India without knowing much about the Indian ecosystem, right? So that's one. As far as the sectors are concerned, we focus on sectors and subsectors which are pretty much nascent and which one can say still at day one. So for example, education is something that everyone likes, but we've been pretty much following since much before the pandemic, right? And rightly so. These are companies working on very high gross margins at scale. These are companies which basically have very strong network effects, right? So once the brand is created, you can really have very strong network effects like the way you have in offline institutions. And given the demography that we have, right, with so many young people, sort of the youngest population in the world, education really has a long way and a long evolution to go. We're also very excited about financial services. So that could be in both, say, alternate lending and robo-advisory and wealth management. I think Zerodha is a prime example of how fast the wealth management category is growing. And that's because millennials are the new face, right? So millennials are basically defining a very different way of existing compared to what the previous generations had, right? So we want experiences over assets. We're sort of shifting from very fixed real estate asset mindset to financial assets. And I think that's a big change. In terms of alternate lending, I believe, we believe that 300 million people, I think, are the people with actually some sort of a credit score in India. And that's literally less than a fourth of the population, right? So you've got a mammoth space there for companies to come and innovate in the alternate lending segment, whether it's in B2C or B2B. And that's going to be very exciting. So you will see the formulation of very large companies, and not just one or two winner-take-all companies, but possibly 20, 30 companies which cater to different market segments, forming large entities by themselves. Agriculture, logistics, for obvious reasons, we are an agrarian society, and that remains exciting. SaaS is quite a deep enabler for all of these sectors. Another sector, which is something that we are excited about, like many other venture capitalists, is the social commerce segment, right? So e-commerce, which is supposed to be a $20 billion segment right now, social commerce would possibly be 60 billion by 2030, right? And India, given the fact that we are a trust deficit society, we transact on a social commerce model. So I think, for us, business fundamentals, clear strategy, large market, and these are the segments that sort of promise everything. And that's what excites us the most.
Interesting. I've been doing a lot of research on social commerce and can't agree more. Yeah. So Amish, so let me come to you. So, so when you work with the global investors, especially whether investing into Indian funds or working with the Indian family offices, working to deploy some capital into the US funds. Just help us understand, the appetite of the global investor base as of today, into investing into India, and what primary sectors are they looking at the moment?
I think one can look at two ways. What is the current appetite, which is slightly subdued still, I would say. We are not out of the pandemic. We are not out of the woods yet. So whether it's India or any other country, having said that, on a relative basis, India has been actually coming out fairly well from this pandemic situation. Now, businesses are trying to get back to normal, and goods and services are being sold. The growth is being forecasted at some decent numbers, not back to the 8%, but certainly in a respectable number, which is probably much higher than what US and developed economies look at. So when investors from US or other parts of the globe, they look at India, sectors, I'm not personally a fan of any sector-specific themes or ideas. It's more the asset classes. And I think it just drives back to the points, how long you want to take a bet on, and how much deep do you want to take the risk. So given those two criteria, I think there is ample opportunities in India, whether it's in public markets, in privates, whether you want to do infrastructure, you want to do structured credit, you want to do early stage venture, late stage venture. And above all, the public markets is a good proxy. There was one statistic which came out on Bloomberg a couple of weeks back. Last 35 years, if you look at the, let's say about 25 stock exchange markets, India ranked second highest in terms of the growth and the annualized return. So it was probably about 13.5 annualized return over a period of 35 years. So investors may say, yeah, you know what, there's a lot of risk on India. You don't end up making money. But guess what, if you are able to withhold for 10 plus years, I'm sure there are good opportunities you need to find. There are ample bad opportunities that may be out there. As Sanjay said, this is a game where you are not investing in each one of them to be a home run, but you want to be thinking like that so that you can take them forward and help them. So I think the investors particularly want the risk to be more subdued. Many of them are able to make, and some are not.
Awesome, great, thank you. So on that note, just to follow up on that, like, so when you work with these investors, how do you mitigate risk? Because every opportunity comes with a risk. Every asset class comes with a risk. Of course, it all depends on the risk appetite of the family or the investor, that are investing into that particular asset class. But any specific risk mitigation measures that you have implemented and any insights for this group?
Yeah, so see, I am more as an advisor. I don't run or manage portfolios. So we are basically advisors to the opportunities, whether it's a fund manager or a private company, and connect them with institutional or family office investors. So the due diligence has been done by the investor. We facilitate the whole discussion, but I think it's very important to curate the right opportunities and then showcase it to the appropriate investors. So what I mean is, if I know an XYZ investor is looking at largely early stage venture, then it's more appropriate to show that versus showing a publicly listed market and vice versa, right? So I think it's a very sophisticated matchmaking that in simple terms we try to reflect upon, but I think we need to know in our business where it is relevant, and automatically the the risk dovetails into the comfort zone of the investor. So whether it is venture or listed space or private equity, I think we ought to do that homework before we showcase to any investors. But I think there are a lot of different sub asset classes one can pick and choose for, and I think India is offering that at this moment too.
Okay, good. I think we are almost, we ran out of time. I'll actually have the last question to Kumaran and we'll do one final round. So Kumaran, to you, any suggestions for this group on how they should look into the real estate? We briefly touched on that, but real estate as an asset class, if someone has to navigate the Indian market, what are 2-3 things that they need to be considerate of?
Okay, so real estate as a asset class in India is going to stay long for a while, because anyway the asset is always in demand. There's a lot of gaps is there in the even end user demand which is already there. So that way the business is going to be go on. So of course, how do we navigate the cycles in between that matters. So we should not repeat the same mistakes as we did last time. As I said, not get into a direct relationship with the developers or the community which is into development directly, because the professionalism is still getting groomed and it's not mature to the level to even appease the institutional capital, because their mentality is to the existing developer mentality is to grow the business in 7 to 10 years time frame, whereas the institutional capital should look at these smaller churns, say 3 to 4 years or 4 to 5 years. So to do that, one, don't put all the eggs in the same basket. So diversify. And diversify, how do you diversify that? try to either invest through funds or have a team on ground to invest across the asset classes or across the platform. Make a platform, do invest in it, and try to be a little more specific in your needs. Like say for residential, allocate say 60% residential or 30% commercial, or some emerging space like say warehousing, logistics, as someone touched upon earlier. And there is another emerging class which is data centers. Thanks to the data center policy of Indian government, where the data has to be stored in the country, the sensitive data. So everyone is building up data centers across the cities. So
yeah. So hey, Kumaran, sorry to interrupt you. I think Amish and Sanjay has a hard stop, and I'll come to you in a bit. So Sanjay, final thoughts. I know the answer, but I'm still asking. $500 million. What do you bet? For the next 5 years. Which asset class, and what do you bet in India?
I think my focus is a singular focus. Startup as an asset class, especially early stage, and that's where I would say across putting all the focus and energy. That's the best possible way for wealth creation, and working across with right fund managers, right investment partners is a great story. I mean, Amish, for example, can help anybody find the right partners, kind of fund managers. I mean, just work with the right people. India is just growing rapidly. It's on a accelerated pace. When there is a saying, which I would like to quote here. If you got a lousy market, even the best of the team will lose out. Even if you got a great market, even the lousy team will make it. So India is right now, a great market. So even a lousy fund manager will make some money. But you always try to get across, strike a magic when you get a great team and a great market. So just find the right people to work with, and I think India has the next decade is for India.
Absolutely, can't agree more. Thank you, Sanjay. Thanks a lot. Amish, final words. Same question.
Yeah, can't agree more to what Sanjay said. So I kept saying again, India, the country whose time has come. I think the next decade, two things we need to evaluate. Relative speaking to other emerging economies, how does India stack up, right? And two, are there any negative connotations towards India with respect to the way the economy and the policies are being moving forward? As long as the leadership of Modi government continues to do the pace at what it's supposed to, I think there is a very strong potential, and there are lots of opportunities. So I think any investor who needs help, all of us on the panel, I guess, are happy to guide them and help them.
Awesome, thank you. Last words, Akash.
Yeah, so I think taking off from what the other panelists just said, it's important to understand that India is, the startup ecosystem in India is not what it was 5 years or 10 years back. It's changing dramatically. It's changing rapidly. We need to look at it with a new lens. We need to not think of it as some sort of a gold rush anymore, although it is. There's definitely a lot of opportunity, but the opportunity is going to be there for fund managers or funds that identify companies that have strong business fundamentals catering to a large market, and the perspective basically needs to be one of large company creation versus investing typically in a startup. So I think that's really important. Looking at it with a very different lens. This is not Startup 1.0, this is Startup 2.0, which comes with a plethora of opportunities, but a very different set of challenges that founders need to navigate, and investors need to be abreast of these challenges so that they can actually help their founders navigate them and provide the right insights which will help them do so.
Wonderful, thank you. Kumaran, final words of thought.
Yeah, India definitely is a growth story for the next decade, as everyone says. So I'll just touch upon one point where we were talking about everything is going towards digital. So digital growth has to be supported by a platform which is which is tangible, more like say infra or real estate, wherever it is. So there's going to be a growth across all. The digital is the driver. Of course, that's going to take up or drive so many more sectors along with it in the next decade. So there's a lot of opportunities across the sectors. And thanks to the pandemic, we have seen the right groups and the right credits, which on the right strategies, which stands out even during this. So it's easy to test now. And I mean, fish the better strategies, better funds, or better investment managers, or better ideas. Now, note it down, and in the next few months or in the next 1 2 years, start building on the investments into it. So of course, that's going to that will take its natural course of the value curve and then give you the benefits. Thank you.
Excellent. Cool. Thank you. On that note, I think I'd like to thank all the panelists and then also Mark for giving us this opportunity today. Thank you so much. I really enjoyed the conversation and solid insights, and I'm sure we were able to provide a landscape of India and the opportunities thereon, and the opportunities for the next decade. So on that note, I'll hand over the screen to Mark. Mark.
Hi, everyone. Yeah, thank you. And thank you, Kiran, for spearheading this. This is, as I said, looking at this as a catalytic event. You'll see the future of work. It's a part 3 for FinTech. It's part 4, education. 2, so my question really to everyone is, what other, deep dive, ancillary deep dives would be interesting? Of course, when we have a venture event, we would like the Indian venture community to join us. It's a global, community, particularly as you move on to the Series B, C's, D's, or you seek expansion. And then a lot of our family offices could be helpful, value-adding investors. We're also connected to the Techstars Mafia, the Y Combinator Mafia, Anil Ranadi's, Peter Thiel. And I always like to tell Peter Thiel thinks he can see any deal he wants, and you guys see it before he does. So if you tell me, then I can prove him wrong. But the key is that how can we help Kumaran? How can we help Jyoti? Help you with Saket? Vijay, you've stuck around. How can we help Vijay as he does his next chapters, and all of us here? But India is the subject. I sent on the chat that video, but you know it better than me. On a PPP basis, it's a huge economy, getting much bigger. So even if it's per capita is 6,000-7,000, the spending capacity as a percentage of that is much larger. So I think the consumer play is huge. I think a lot of our investors are sophisticated, but they're not. Some of the families aren't even thinking about India either as a destination, but they need to build relationships, and that's sort of what we're all about. So, have a think on it. If you got any thoughts, we always sort of leave this time a little bit open to sort of like Clubhouse style. If everybody's on Clubhouse, you'll see our Clubhouse set of events starting. I don't want to go full on Clubhouse, but we sort of do that, by the way, with our Wednesdays. I know the timing doesn't always work out with India, but 10:30, all of our groups get together. And we have a lot of groups, like India being one of them. So yeah, just how do people want to, what would be an interesting event? Or if you, those in India, how would you, you see events here, just let us know if you want to get involved in any of them. Thoughts? There's always the pregnant pause, right?
Mark, I'll share some thoughts. I really appreciate you coordinating this, and everyone at various time zones really appreciate you sharing your insights. I think what would be helpful, I'm a US-based investor, but I believe very much in the long-term story in India. I think what would be helpful is, more specific details on maybe, a prior investment that you guys have made. It doesn't need to be live today, but how you thought about it, what are the return potential, what unique insight did you bring to the table? I think understanding the micro as well would be very interesting, perhaps for the next time. And I know it's not as relevant to most because it could be very specific, but at least it gives an insight into what you're seeing on the ground and how you potentially identify the opportunity and potentially add value going forward. So that specificity on the deal could be very important.
Are you
Thank you.
Are you talking more on the private side, or would you look at?
Yeah, or even a specific stock. You know, I know that Saket had mentioned the general overlay of consumer discretionary, but maybe, you know, a favorite idea that they have, whether it's in the past as a case study or current, I think that could be very insightful. But thank you all.
Saket, are you there by chance?
Yeah, Mark, I'm there. So, you know, I would be happy to sort of probably as on a one-on-one basis, you know, connect with Vijay. And Lisa, you know, who's our marketing person in the US, can sort of coordinate things. And we would be happy to sort of share ideas that we have held in the portfolio and our thinking and how they have played out. We, in fact, also, you know, send out a quarterly newsletter to our investors, which, you know, would have the initial investment thesis and, you know, that we would have on a particular company when we invested and how it sort of played out. So would be happy to do that, you know, when we have more time.
Yeah, I think this is a day to sort of start getting to know each other. We can go into you can do your sidebars anytime. If you know, talk, you can call on me as well as Lisa. We can coordinate. And if you see good managers, I was asking about secondaries for a reason. You know, we're always looking for good managers to back and bring on, or deals. We tend to like the funds over deals because the managers bring us the deals. Sorry. And if there was a fund for India, I'd be curious about it. Anyone else?
So just a comment, Mark. I think this was an excellent opportunity for all of us to learn about opportunities in India and also to provide an overview of what would be the preference of a few of the important investors at various sectors in India. I think such initiatives and such regular events can be of a great benefit to all the participants, and I'm happy to contribute to this community. I have helped many MNEs and funds to explore their investment decisions at India. So I'm happy to be of assistance to the team.
That's great. No, we greatly believe in having roundtables, and you need your lawyers and tax advisors at the roundtable, like yourself. Anyone else? Greg, are you still on? Because you play the emerging markets. Just curious what your view is on what you've heard.
Yes, I am still on. When you put together panels like this, somebody like me who's a generalist sits back and listens and learns. But everything was on cue with what I think about India in terms of the opportunity, but in terms of the difficulty of investing. There's still pretty strict rules on direct participation locally in the Indian government, and over the years what's happened is a lot of the instruments that offshore fund managers have used have disappeared. So it makes it a little bit more difficult for smaller funds in particular to access India. I mean, partnering with locals, I think, is top of mind. I found in the equity world, and especially everybody's been talking about small and mid caps. And there's a cottage industry of very, very smart and connected fund managers in India itself that really dominate that market. So it's very, very hard to compete against. So I think this is a great intro. It hit on every single relevant topic that I could possibly think of. The next steps, I think, are how do you lose the apprehension of investing in India and start participating. Another general question that just came to mind to me is it was a big focus when it happened, but it's not talked about, but I think it's going to lead directly into the adoption of digital. And when I think of these things, I think about formalization of economies, which I think is a very big deal in India, is the experiment of being one of the first countries to curtail the use of cash. And what's happened there in terms of has that pushed more people into the digital realm, and is that leading to a very high degree of formalization of the economy, or not yet?
So,
so go ahead, Sally.
Yeah. So I think, Greg, you have to look at demonetization, where Mr. Modi sort of banned the cash, along with some of the other initiatives when you think about digitization. So I think apart from demonetization, one very important tax law, which got implemented in India was the introduction of the goods and services tax, which makes tax evasion very difficult, and also has been a very big contributor for accelerating the change towards the formal economy. So I would say these things have already, the trend was there, the market was shifting towards more organized players. Demonetization and implementation of goods and services tax has only accelerated that trend. And similarly, use of digital payment systems was growing at 30-40% even before some of these initiatives. But after COVID, after demonetization, after GST, those growth rates has only accelerated. So I think the trend was already there, but it's already, given these tailwinds, the trend has accelerated in recent past.
Thank you.
Anyone else? Simon, are you really still here? You can't believe you actually stayed for 2 hours on any one thing. Testing.
That's your answer.
He might just jump on and surprise me. Anyone else? Jim, Uncle, Samir, good point on secondaries. Rob, Pat.
I don't know if Rob Colorina is still on, but he had the brick question. That was a big theme in the previous emerging market boom. I think it's gone by now.
It was a Goldman analyst.
It was the head of it was O'Neill, right? Jim O'Neill, who basically came up with it, patented kind of it, and ran with it. And it goes with my theme that at the time it was smart, because you still had a large cohort of investors who were not involved in emerging markets, and you still had remnants of those things I talk about, which is what was emerging markets when the term was coined, which was a group of countries with similar problems. Right? Things have evolved very differently everywhere today. Maybe the demographic element is still there outside of Russia, perhaps. But in general, I think it's kind of failed as a political agglutination of countries, and it's failed as an investment thesis as well, I think.
Well, again, thank you, everybody. To the extent that you've got any suggestions, beyond what we've heard, I think Karen will compare notes and come back. Sometimes, maybe to Vijay's point, it's always good to bring actual companies in instead of not just the financial engineers, and get a CEO panel of sorts, what they see on the ground. Particularly if we could bring some who've got some cross-border experience, good and bad. Get those voices in here. And this has been good for me, just even for me to get to know Amish and Lisa and what they have on our platform already. So we'll pay more attention. 11.5% this year, Karen? Is that the number?
Yeah, 11.5. Let's see how many we do.
Yeah.
What was the final in the 2020 number, or where do you think that's coming?
No, 2020 we had a contraction. I think it was -8 or 8.5.
Okay.
So ideally,
-7.5.
Okay, -7.5, right? So ideally, so let me put this in perspective, right? So IMF says, you know, you need to add 2020 and 2021 into perspective. So just to give a perspective, China actually grew at around 0.9% in 2020. That's the only country which has some positive GDP. And then it is expected that China will grow at around 8% in 2021. So if you combine 2020 and 2021, it's like close to 8.9. You average whatever, it's like, you know, close to the double-digit growth, you know, that China has. So IMF says, you know, don't get excited about 11.5. It is good, but you had a contraction. So if you add the contraction of -7.5 plus 11, you know, it's like close to 3 to 4.5% growth, you know, that India will see, you know, during this time frame, which is not bad at all, to be frank, because I think India was under some kind of recessionary path, you know, even before COVID hit, and we had a couple of issues within the banking system and all. But this is a very good starting point for us, you know, to rebound and to accelerate from here.
Yeah, and if I may add, I think if you look at the long-term growth, India has grown at around 7% for the last 2 decades. And my sense is a growth rates in that range is possible for the foreseeable decade as well. Typically, you know, you have cyclical lows and highs. So in good years, the growth can be as high as 8 to 9%. And in recessionary times, in India still grows, but, you know, growth decelerates to maybe 5% or so. But on an average, over a long period of time, I think 7% real GDP growth. And if you add 4-5% inflation, we're talking about around 11 to 12% nominal growth is what I think India has delivered over the past 2 decades and should be able to do over the coming years as well.
There was some confusion a few years ago about the methodology of calculation of GDP, right? And a lot of debate around that. That's been digested, right, by people by now?
Yes, I would say this was more a political debate than an economic debate where, you know, an incumbent government wants to show that how the country did much better during their political time frame rather than the previous party. So I would say it was more to do with the politics around it rather than pure economic theory around it. But otherwise, like I said, you know, India has grown at around 7% on an average. You can make the numbers look slightly better in certain years versus others, depending on how you collect the data.
Yeah. Thank you.
Well, I've been navigating on purpose on our app. So, you know, we now have 2,500 people have been to our events, and we have 700 on the app. I prefer everybody join the app for a couple of reasons. One is we get to know you, and it is a community. And if you tag yourself, like this is the India tag, and this is a bit newer, we're a startup on the app side in particular, but if you, and then we've asked a lot of people through our homepage to post using hashtags as much as you can, because then we can all, like that was India. India didn't have a lot of content, but we have deals, strategic advisors, you know, really, because we say people are looking for a deal, capital, deals, or talent, that triangle. And that's how we sort of form our communities. So if it's India, you're looking to deploy or more capital into the India deals, or you need to access, you know, somebody like Mudal, you know, to get a deal done. So join and engage. That's how we evolve. Great. Well, thank you, everybody. We'll keep the conversation going and deep dive 2, 3, 4.